according to Andre Geek, the recession just got worse. Yes, just when you thought it couldn't get any worse, it is getting worse, and everybody is freaking out. So, Andre Geek has helped us to be able to look into it as to what factors are actually driving this worseness. I think some of the things he says are on point, while other things are Anyways, let's get into it and see what Andre has to say about it, because he's a pretty smart guy and he usually knows his stuff. Let's see if he's on point this time. Here we go.
Just when you thought that things could not get worse, it just did. The stock market and the recession definitely did, because over the weekend, the S&P 500 dropped a massive 3.5%. But the reason why it dropped is because of Jackson Hole, Wyoming. I know it sounds crazy, but it's true. Every year, the Federal Reserve Bank of Kansas City hosts a giant meeting of bankers, policymakers, academics, researchers, and economists at that meeting. And there's some pretty big players like members of the European Central Bank, a chairman of the Swiss National Bank, a professor from Harvard.
Who are these people?
Our favorite Federal Reserve Chairman Jerome Powell, aka Royal Penguin, who is ready to migrate the heck out of the US because he is so sick and tired of how hard his job is. But in that meeting, which lasted throughout the whole weekend, the economists got together to talk about where they thought the economy was going. In fact, there's a video of Jerome Powell giving his speech, but that video had only a...
So they had a meeting to talk about where they think the economy is going. I'll just correct that by saying they had a meeting to talk about where they plan on where the economy is going. You think in a room that's filled with politicians, bankers, and all the powers that be are there to try to figure out where is it all going to go? It wasn't like that at all. It was more like, here's what we're going to do, and here's the plan, and at the end of it all, you will all be richer. It went something like that. That's the truth. So I just want to correct that point, that it was there so that they could try to figure things out. Nobody's trying to figure things out. It's all planned. So let's just go with that in mind. Here we go.
11,000 views, which makes me sad because my new YouTube channel, Don't Sweat It, where we sit in a sauna and just sweat it out and talk about literally anything, with 0 subscribers, got more views than that on my first video. And I don't think it's anywhere near.
You know what else got more views than that? My son actually doing a short got more views than that. That's how bad that is. The fact that Jerome Powell couldn't get more views than my son, who's like not even 11, is pretty sad. So, and even his video of like, being in a sauna did better. So, not looking good for the economy, folks. Anyways, let's keep going.
As important, but
you should still subscribe.
So I'm just gonna assume you did not watch Jerome Powell's video because you had better things to do, like literally anything. So let me just paraphrase it here.
Chair Powell, the floor is yours. Please come to the podium.
This thing on. Expect more pain ahead.
Oh no.
No, it actually was a really good speech, but the most interesting part about it was that before this meeting, the stock market thought of Jerome Powell as what's called very dovish on inflation, meaning very slow to fight it, and he's famous for saying that he would allow the data to lead his decision-making process. But at this meeting, he did not hold back any punches, and he said it like it was. In fact, he gave 3 lessons that he's learned over the last 50 years from his predecessors that he wants to make sure that he's going to follow through with. So in today's video, I'm going to show you what those lessons are. I want to help explain what he said about the economy and the pain ahead, and then I'll tell you what happened to asset prices and how this will affect us. So with that said, let's get right into it. Hi, my name is Andre Geek. Hope you're doing well. Come for the finance and stay for the breakdown. So first, we'll talk about Bitcoin, real estate, and the stock market. Then we'll talk about the Fed's favorite way of measuring inflation, the PCE, which is super nerdy stuff. And then we'll talk about what was said inside of this super secret meeting, which actually wasn't secret at all. It's just that no one paid attention to it. But first,
that was a secret meeting,
Bitcoin,
and they planned it all.
Its market cap dropped to $385 billion, or less than $20,000 per Bitcoin. That's a price level that a lot of investors never thought we'd see again. But as a reminder, if you're a crypto investor, just remember prices could always go way lower than you ever thought possible. So just be very careful. And it's also why I never invested more than 10% of my net worth at my cost basis, because it's extremely risky. Now, when it comes to real estate.
Okay, so Andre's talking about Bitcoin, and he's talking about only putting 10% of your portfolio into Bitcoin. And he also said, oh, they never thought that we'd ever see under 20K again and whatnot. Let me tell you something. If you've been in this space long enough, you will see comments like that all the time. It is absolutely going to happen. You're absolutely going to see people claiming this is the price bottom. We're never going to see this again. And it'll be repeated at every single price level. Trust me, it is going to be done over and over again because it's just human nature. They like to make claims like this. Maybe it's just their hopium, whatever you want to call it, but it's the truth. You're going to see the price fluctuate. It is a volatile asset. And in the long run, it doesn't matter. It really doesn't matter. So if you're in the long run, which is what you should be doing, you should be hodling when it comes to Bitcoin, then having the price fluctuate all the way down to 19K when people thought it was only going to go to, it was never going to go below 20 is just the nature of the beast. So if that's not good for you, then maybe you shouldn't be in Bitcoin. But that is where all the wealth will be for the future. So he's getting into real estate now, so let's hear that.
Mortgage rates on a 30-year fixed home loan have gone up to an average of 5.5%, which is insane.
Ooh.
And sellers have become a little crazy because between the week of August 20th and August 25th, the average list price went up 14.4%.
What?
But that's also why homes have been sitting on an average of 4 days longer. And new listings have actually
4 days is
decreased
nothing.
12%, which suggests that sellers want to wait and see what happens to the market. But nationally speaking, inventory levels have climbed to the highest levels that we've seen since 2009. And that suggests there's going to be a lot more pain ahead. So if you're in the market to buy a house right now, I would say wait a little longer. And by a little, I mean a lot. Now, as far as the stock market goes, though, it's also down a lot, thanks to what Jerome Powell said, which is thanks to what's called the PCE, the personal consumption expenditures. I don't know why they give them such fancy names, and why couldn't they just call it the price change of the stuff we buy, because that's what it is. Now, remember, in June, we set a 40-year record high of 6.8%. Now, remember, we're always 1 month behind every time we get the data, so when we got it in June, that was May's data, right? And that's coincidentally when gas prices were extremely expensive. But
so isn't it funny how the market reacts to data that's a month old in a way as though it just got announced that day? I just find that funny. It's almost like they're looking for an excuse for a party, whether it's going to be bull or bear. I don't, it's just funny how that works, right? It's like all this data, he's making the point is like, look, all this data is a month behind. So it's like, this isn't what's happening now. This is what happened a month ago. So why would the market make moves based on stuff that's happened over a month ago? It makes no sense. I think they just look for an excuse for a party. And this is just the kind of games that the markets play in order to be able to make the rich richer. So that's what you get into. That's what you're dealing with. So it's all part of the system. See the rest of this. Here we go.
the most recent PCE reading was 6.4%, which suggests that inflation should finally, hopefully, start to come down. But remember, that's also data from July. Now, the bad news is that PCE is still 6.4%, and that means we are very far away from the Fed's target rate of 2%. Now, the even worse news, though, is that
so the Fed's target about 2% that you keep hearing about, there's this, it's this fabled concept that if they can keep inflation at around 2%, that they would be able to actually be able to keep on printing money forever, like fiat money, the way it works, where they have a money printer that goes on forever and ever, and there's just more and more money that goes into the market. And if it could be just at 2%, then everything will be fine. There is nothing to suggest that this is the truth. Like that's how it would work. It would work. We've never had it anywhere in history where that actually worked. So this idea that, we need to hit 2% is sort of like a straw man. It's like this idea that you have to, if we can maintain this fake money as long as we have a 2% inflation, but you never get there. And on top of that, when you do get there, it really doesn't work anyway. So it's a straw man concept in economics. And most people who are very learned and very educated, they accept the 2% as though it is, gospel, like truth. And there's just no denying it, because all the other economic theory around it expects that that's how it should work. And unfortunately, as a system, it doesn't. So just want to make that note, but let's go on with all the funny numbers.
Inflation,
money.
or the PCE, at the end of this year is predicted to reach about 5.2%, so nowhere near the target rate of 2% either. It's not until 2023 when we get to
Nowhere near.
2.6 and 2024 when we get closer to the Fed's target rate of about 2%. The good news though is that it looks as
I'm
though
not very
inflation has
convinced of
already
that.
peaked. And the reason the stock market is predicting this is because of the single biggest contributor of inflation, which are gas prices, which we could see are starting to come down. So assuming nothing else changes and gas will continue to go down, inflation should also come down. But that's only a theory and maybe famous last words. So that's what happened to asset prices and inflation. Now let's talk about this super secret banker meeting that happened in Jackson Hole, Wyoming. So here's what Jerome Powell said in that super secret meeting. He said, in order to bring inflation down to 2% and stabilize prices, that they'll have to be below trend growth and that we'll see a softening of the labor market. And this
Softening of the labor market? What does that mean? Oh my gosh, that does not sound exciting at all. Cringe. Anyways, let's keep going.
is just a fancy way of saying
They will also bring some pain to households and businesses.
this means that people will most likely lose their jobs at some point. He says even though the economy is strong right now, the labor market is way out of balance with far more job openings than there are workers willing to work those jobs. And then he says something that a lot of people are probably thinking right now.
A single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
So ultimately here he says the Federal Reserve will continue raising rates as much as they need to, even if it means not printing money a la Super Mario coin block style for quite some time. Then he
That image of Super Mario just jumping and printing coins, that's the Fed, just so you know. It actually works that way.
goes into his top 3 lessons that he's learned over the last 50 years. And these are actually really interesting. Lesson number 1, he says, is that it's his job, and by extension the Federal Reserve's job, to keep the economy stable. This is his way of saying, I'm not going to wait for the government to do their job.
It's his job to keep the economy stable, and he can't wait for the government. What does that mean exactly, to keep the economy stable? In their job as the Fed, the truth is, like what he means by keeping the economy stable is simply to ensure that people continue to value dollars, US dollars specifically. And that to them is stability. Doesn't matter if you're poor, doesn't matter if you're rich. Well, yeah, they want all their buddies to be rich, but it doesn't matter how poor you are. To them, as long as everybody's continuing to use US dollar and it continues to have its dominance, that is economic stability. Doesn't matter how bad things are, as long as the dollar dominates. That is his job. So be clear on that. That's what matters to him. That's his job. So as long as that's what we're looking at and you understand that in the back of your mind, you get a better sense of what's really going on. All right,
I
number
have
2.
to do it myself. Now, lesson number 2 is the game of
Psychology.
This is what economists like to call consumer expectations, and it's super fascinating. Check this out.
If the public expects that inflation will remain low and stable over time, then absent major shocks, it likely will. Unfortunately, the same is true of expectations of high volatile inflation.
And this makes so much sense because if we think prices will go higher, then of course we're going to spend our money today rather than wait until tomorrow. But ironically, that's the self-fulfilling prophecy of inflation, and it's exactly what happened in the 1970s. Now, thankfully right now, the general consensus of the public is that we all think that inflation will come down, which is a good thing, but that's what he says they have to fight, and that's why lesson number 3 is to be persistent about destroying this thought of inflation when we go shopping. So that's their 3 priorities. Now, if you've made it this far into the video, even though you didn't ask, let me give you my personal thoughts.
I'd love to know your thoughts about this because there's kind of 2 sides to the argument on this one. The first side is, of course, Papa Jerome Powell's side, which is just let's increase interest rates, bring demand down, and inflation will cool down, right? But on the other side, people like Senator Elizabeth Warren are saying increasing interest rates does nothing to help the reason why the economy is really suffering in the first place, which is that we have to fix the supply chain problems, right? And by increasing interest rates, all that's doing is putting the economy more at risk, and people could lose their jobs, which would be a horrible situation to be in if prices are also especially high. So
Yeah, I kind of agree with Elizabeth. Elizabeth Warren pretty much hit the nail on the head that there are some serious systemic issues, especially when it comes to the supply chain. There are geopolitical forces that are manipulating that. So as long as that continues, all that they're doing in terms of like turning these dials with interest in order to be able to fix the economy or be able to handle inflation and whatnot is doing nothing as far as like fixing anything. And she's right. So I have to agree.
Those are two sides of the argument. Now, this is probably the angriest that we've all ever seen Papa Jerome Powell. It's almost like he was frustrated that the market wasn't taking him seriously enough. And now that he's emphasized just how strong he's about to get on inflation, and he'll increase interest rates no matter what the cost, the market was fine.
I literally didn't hear anything he said because of the bird. Anyways, let's keep going.
Finally like, okay, fine, we believe you, and the market sold off. Now this also means that more than likely, when we get the next inflation report, the Consumer Price Index, which will be released on September 13th, regardless of what that number is, the federal funds rate will go up substantially. My money will be betting on at least 0.75%.
Wow.
Now it could be 0.5%, but based on what Jerome Powell has been telling us, managing the average everyday consumer and business person mentality is the #1 priority. So he wants to beat us up with a club over the head with those 0.75% increases until we think, okay, inflation's gonna come down. Now for me personally, even though I think I'm right, because I follow this stuff religiously because I have a YouTube channel and no one cares other than nerds like me.
We care.
At the end of the day, I'm not gonna speculate with my portfolio and try to time the market. Even though some people are upset that interest rates on loans are about to become more expensive, chances are stocks, real estate, and crypto will continue going down. So it's very tempting to sell everything and wait. Just remember this chart. There will always be a ton of great sounding reasons to sell your portfolio and wait, but chances are the stock market will recover and you just never know when and for what reason that will happen. So for me, I will continue to reinvest all of my dividend income via the DRIP method and continue buying the broad market index fund that is the VTI stock.
Buying an index fund in this kind of climate's actually a pretty bad idea. He's probably not going to be happy with the results at the end. Index funds are notorious for investing in various kinds of companies that don't produce enough value. I wouldn't recommend doing an index fund. This is where I don't agree with Andre, I guess, on this point. He also just noted the historic chart of like the economy and growth, and if you look at the graphic, it actually, he cuts off where we're at now, where everything else is kind of do, but then we're actually like, whoop, like that's where we're at now. And he's expecting it coming back down, but I just don't see it. Also, these rates and the idea that we're going to get hit over the head with a stick, as he put it, to finally believe that inflation is going to come down. Yeah, I don't think so. I can't agree with that assessment, only because the Fed isn't in that position to be able to reel this in any significant way. I know that the idea is like, if we keep raising rates, then people are going to believe it. The truth is, people just don't have enough money to be able to live, and they're going to keep on spending as much as they can to be able to survive. And I don't think that like right now, there is people out there who are making over $250,000 a year that are living paycheck to paycheck. 36% of people who are making $250,000 a year are living paycheck to paycheck. Think about that for a second. Imagine how much worse it is for everybody else. That is not an inflation spending issue. That's a systemic, oh crap, we're sinking issue. So if he thinks that this is just going to be some kind of other cycle, I'm sorry, Andre, you don't have it. You don't have it right here. This is far worse than you think it is. So that's my assessment, though. That's his thoughts, my thoughts. You can decide for yourself. I'd love to see in the comments what you think. Let us know. Let's keep going.
I think the ultimate truth, though, is that we need to bring the economy back to reality, and the longer the Federal Reserve delays the inevitable pain of increasing rates, the worse the economy becomes for us in the future. So for now, I'd brace myself, build a bigger cash position, build a larger emergency fund, because you never know what could happen, especially with what's going on overseas. But as far as Jerome Powell is concerned, I think he's doing the right thing, but of course, I could be wrong, and I'd love to know your thoughts.
So that was The Recession Just Got Worse with Andre. I really appreciate some of his thoughts on this. I didn't agree with his final assessment on things because, simply put, I think it's going to get far worse. He also doesn't seem to be a real believer in Bitcoin. Like, I don't think he's really getting into the macroeconomics of the fact that this is the dollar that is in a state of like that is being it's in so much strength right now in the macroeconomics of it all, but the fundamentals holding it up are completely a mess. And I don't think he's really looking at it from that perspective. Bitcoin, on the other hand, has very solid fundamentals. I think that we're going to see a race for people to find some kind of cover, and they're only going to find Bitcoin as being the only asset that isn't being inflated into the nines the way everything else is. Right now, there's this correlation sort of thing happening. I think that's going to end really soon as this process continues. And then you're going to start to see a real shift in the way that people think about money. So if you think that this was helpful at all, please sure to like and subscribe and do all that crazy stuff that you do at the end of videos or during the video. It would have been better. And of course, want to hear your thoughts on what you thought about this topic. Do you think the recession just got worse, or do you think it's actually going to get better? I don't think it's going to get better. But do you think that it's really as bad as what Andre says? Do you think that Bitcoin is the answer, or is it going to be US dollar all the way? Let us know, and we'll be sure to see you in the next one. Take care.